Anuj Ranjan, CEO of Brookfield Private Equity, joins us today here in Hong Kong studio. How are you doing, sir?
Great, thank you.
Yeah, so, I mean, what kind of deals are you going for? And do you bank on more companies staying private? Because that's what I've been reading about. A lot of the U.S. companies, at least, upstarts, choosing to stay private. Do you think that is really the big trend that you need to be eyeing?
Absolutely. First of all, thank you for having me. And we believe that the world's best businesses, they're built, not just bought. And oftentimes, building these businesses into the global champions that we feel that they can be are best done in private hands. In our business, we've often acquired great businesses, but we've made them better over time through our operational capability. And I think the new era of private equity, most of the managers in the world will have to bring something special to a business they own in order to run it better or to make it more of a real global champion.
Why are these companies choosing to stay private?
You know, the public markets have rewarded some of the largest companies in the world that have a lot of the trends that we have seen in specifically technology, but it hasn't rewarded all companies equally. The capital needs involved in some of the companies, especially those going through a transition, is not always best possible within public markets or public hands or within a conglomerate even. There are even conglomerates that are selling divisions, and you're seeing more and more of that these days because it really takes a specialist capability to make a business better. And that is best done with more focus. That can be done in a private markets type environment.
So, in your portfolio, how has valuation fared? Did they suffer and come back a little bit? And what is the exit environment? Because a lot of headlines are sounding very scary, negative. I mean, not being able to mark to market yet, and then there's something brewing there, something bad is brewing there because we don't really have a lot of visibility. Give us some visibility.
Well, there's a lot of headlines that private equity can't find exits. I don't think that's entirely true. I think private equity is such a broad term. It encompasses quite a broad range of companies. We've returned $10 billion to investors just in the last 18 months. That has been done through exits. It's been done through dividends. And it's been done through owning businesses that generate a lot of cash flow that buyers want and being able to exit them and sell them at reasonable valuations where we still earn our returns. So the truth is the era of easy money is over. And I think the next decade of private equity returns are really driven by operations. We've moved from roll the dice to roll up your sleeves private equity. You have to be able to improve the margins, improve the cash flows of a business in order to generate those returns.
Marty?
Anuj, great to see you. Good morning. Listen, I got to say, right, Brookfield, especially your private side, the private equity side, has gotten some flack, a bit of flack, I think would be fair to say, for your performance being largely financial engineering, leveraging debt, complex financial transactions to try and immediately juice your numbers. But to your point, you're saying that, look, we do things to a company's capital, but it's more about building back a business. And I want to throw out two case studies or examples, right? Westinghouse is one that you turned around. GrafTech is another. Today, though, in your portfolio, what are the ones that you are most optimistic about being able to create more value from, and from an operational standpoint?
Those are some great points. And we have about 46 companies in our portfolio. Many of them are very exciting today. You hit on GrafTech and Westinghouse, two that we've managed to exit that were really fantastic for us. A few that we own today, examples include Clarios, which is the world's largest manufacturer of low voltage batteries, specifically for use in automotives. This was a company that was, I would say, undeservingly unloved. And we've been able to take the business from about $1.5 billion of EBITDA when we acquired it through to about $2.2 billion of EBITDA generated today in just a few years, largely through operational improvement and value creation in the portfolio. Another example of a space that we've been investing quite heavily in is financial infrastructure. And this is the backbone of the financial backbone of the global economy, largely digital assets that move money around the world, like payments. We've acquired businesses like Network in the Middle East and the Barclays UK payments business more recently. These are leading companies, essential products or services with very large market share, where there is a significant amount of technology investment required to improve margins and to future-proof the businesses. And not everybody has the capability to do those in-house, and that's something that we've been able to build over decades. That's really allowed us to generate leading returns in those investments. And to your point, cheap leverage, a very healthy growing market with strong GDP growth was helpful to private equity historically. For 15 years, private equity could probably earn its base returns, not doing as much heavy lifting. Those days are behind us. For 25 years, we've made all of our returns through operational improvement, and I'm very happy that we're back to an environment where that is the real differentiator.
No, I got to say, in terms of leverage, et cetera, after a pretty tough last couple of years, before January 20th, I think a lot of folks were optimistic that, okay, good times are back, or it's going to get much less bad for PE once Trump gets into office. I'm not sure whether that's quite played out that way because of tariffs and a whole bunch of other things, right? I think the risk is that the shape of the curve is going to steepen further, right? Rising risk premia, term premia as well. What does that mean for your private equity business, one, especially in terms of terming out your exits? Or, I mean, are you going to be, is money going to be stuck in there for longer before they can exit?
You're right. At the start of this year, I think everyone would have predicted this would be a great year for M&A activity, a great year for transaction activity, and it hasn't turned out that way. But I'd say two things. First is we are seeing signs of it coming back. The debt capital markets in particular have been quite supportive, and we have been seeing more and more activity, even on the public markets side. While IPO discounts are, of course, required, and they may be steeper today than they were in the past, we're seeing signs of them coming back to life, and the M&A markets as well. In terms of businesses and in terms of being able to exit, I think it really comes down to the type of business you own. If you own a market leader that provides an essential product or service and it generates a lot of cash flow, banks have always loved, or the debt capital markets have always loved financing those types of businesses. And buyers, often strategics, are very happy to own these kinds of companies in their portfolio. Of the 9 exits we did in the last 18 months, 8 were to strategics and only 1 was to another sponsor. And we have a business today that we are looking to sell where we have 20 people actively doing work. So by no means is the market dead. It's just people are choosing the areas that they want to invest a lot more carefully.
The kinds of companies that you invest in, right? You mentioned essential a couple of times already, whether it's products or services, right? So that's industrials, infrastructure, and back-end technology. Not terribly sexy, but very, very necessary. My question to you is, I mean, not all of this is rocket science. Why are you able to find companies like that? Or the other way of asking is, why are companies like that so badly run that they need your help?
That's a great question. I think it's what we like to say is we want to go for companies that are undeservingly unloved. There are companies that are unloved, maybe with good reason, and there are companies that sometimes have some noise around them, some misconception in the market. That means others aren't as interested in them at that time. If you're looking to make a quick buck investing, that isn't the space that we focus on. It's a lot of hard work to carve a company out of a conglomerate, stand up a new management team, put in place an operational capability and a value creation plan to run the business far better. And I think that scares away many investors that are used to investing in a time when returns could be made in a much easier fashion.
What kind of exposure are you looking at in terms of AI story? Because I wonder, if you're locked in for 5 years, for example, how do you know what AI story works 5 years later when you're looking to exit? And how do you know that you're not overpaying for something that could actually go obsolete even?
Yeah, it's a great question. I'd say I definitely believe that we are in the midst of the 4th industrial revolution. And the key word in that is industrial.
Yeah.
You have all of this investment in technology and all of this CapEx going on all over the world. But all of that isn't really worth much if we don't see real industrial productivity gains in actual companies. I do believe the technology has gotten to a point where we are seeing those real use cases today. And so for us, how we want to think about from a private equity perspective, AI is as another tool in our digital toolkit to enhance the operations of our business. At its most basic.
Is it energy? Is it chips when you say industrial part of AI?
Well, I'm talking about any business we own where we can use AI to increase the productivity of our people in that business.
Those are beneficiaries of AI.
Exactly, and that's where I think we have always bought great industrial companies and we've made them better. We've increased their margins. We've often bought businesses that had 20% margins and made them 30 or 40. With AI, we can buy those same businesses with 20% margins and make them 50 or 60. And it's another tool to use to enhance margins, but it's much faster and it's moving much quicker than I think anyone could have imagined. We're using it in everything from automation in manufacturing facilities. We're using it as customer service agents for a lot of the service businesses we own. And we're looking at and I'd say the front line of thinking about robotics in a much more advanced way for some of our businesses where we produce a lot of products.
Robotics it is. So thank you so much, Anuj, for coming in this morning. Interesting conversation. That was Anuj Ranjan from Brookfield Private Equity.